Welcome everyone to the first informational webinar held by Forex Overflow team, which is typically going to focus upon giving you limited but required information about the brokerage industry of Forex. So technically, who are brokers? What kind of brokers exist? You know, we are going to here typically talk first about what are the types of brokerages. May it be the same word, brokers, brokerages, trading house, or relate to the same thing or the same terminology. And I could term them under three categories: A book, B book, and the C book, which is also coined as hybrid book nowadays. So let's break down each of it with at least two slides explaining how they operate, how they benefit. So let's march to A book brokerage. So the broker that takes opposite side of the client trade but transfers the same exposure with its liquidity provider can be termed as a book broker. This is what I can coin you as a theory, okay? But to make it into reality, to make you understand this in reality, I would like to bring to your notice that this word is something which you might have heard first time, the opposite word. Because usually it is marketed that a book means bank's book. No, it's not that way. Let me assure you, this technical explanation might be sounding very different for you, because I know I have seen the videos of YouTube, I have seen the write-ups of very renowned authors of Forex industry saying a book broker means the banks which are trading side by side with brokers. No, it doesn't term that way. There is also a term called as ECM, STP, NDD. Okay, we shall be covering these topics, but not in today's book, but on later part, because they tend to have some advanced edge to these terms which I am coining here. Okay, so now when I say opposite, the first thing that can hit your mind is, why is the word opposite coming in a book execution? See, it's that simple, guys. A broker is one who earns money or can create revenue by broking the deal. He has to do something in between two things. Okay, he is not going to do something on his own, or it's not going to make money on its own somewhere. Somewhere somebody has to work. That's how somebody is going to make money. And we all should be very clear about it, how these things are going to work. So, not to waste time on it, not to make confusing statements, I'll straightforward explain you all how this brokerage industry works, what are its models, with the best of my knowledge. So let's solve this questionnaire of opposite. What actually a book broker technically does is, when a client, assume a broker is having a client, and the client says the broker, this is the client. Okay, I should make a writing for you so that you can better understand it. Here is a client and here is a broker. Okay, so the client tries to buy something from the broker. Right now in these transactions, what actually happens is, whatever the client has bought, assume the client has bought gold, the broker would be selling it to him immediately, but at the same time, the broker would be buying the same from its LP. LP stands in here as liquidity provider. We will discuss these terms in future, not today, but I am trying to explain you that why is this word opposite being mentioned here? Because initially, what you are buying from the broker, the client has a opposition to its position. You are buying, but the broker is selling you. But since it's a book execution, the broker is equally buying the same value worth of gold from its liquidity provider so that the broker stays 100% hedged. Yes, that is what is important for a healthy book broker. Okay, this is the most important part. The word hedged, this one, that is going to play the majority importance to it. A broker which is not 100% hedged cannot function as a book. Then he is bringing risk to his book. Okay, so I hope I have solved this opposite term in the word, because many of would be questioning. And please feel free to write me in comment section. I'll be happy to write, reply, or whatever the way can hold another informative webinar to cater the requirements. But let's try to make a difference in understanding. Because why is this first topic of this informative webinar? Because majority of the people don't know who is the right kind of broker for them. And it's not a worry about institutional or retail. Every investor is an investor of its own kind. A $500 investor might be a retail client for a broker, but who knows that $500 is all the client has to put in. Same case can be for $500,000 or $5 million. It's not as per the client's appetite. It's not as per the market's appetite. It's about what are you trying to do with your own money. Okay, so let's stick to book execution. The book broker is simply going to hedge all your positions with equal weightage with its liquidity provider. So in simple words, a book execution always will have three counterparties: one a client, one self, and one its liquidity provider. Without this, a book execution cannot be done. Liquidity provider can be anything: banks, financial institutions, non-financial institutions, and much more. Okay, let's move and see how does a book broker makes money, because everyone is here for money. There is no charity involved anywhere. Okay, there are only two traditional processes in which a broker can make money using a book. One is via charging flat commissions per dollar by the client. Let's say the client open any trade, the broker charges flat commission. And as far as I am trying to tell, I am trying to explain about transparent brokers here, not about shady brokers. That is a later part. A transparent broker will always mention on his website his charge and his fee structure very clearly. Yes, I mean it. A transparent broker, please use the word transparent. Where this word transparent comes into picture, a book broker is bound to play its role. Okay. Second thing, markup. When we talk about markup, what is it going to be? Whenever the client is going to make money, it's not mandatory for a book to make money, because he is using hedging algorithms, or he's just forwarding his risk, whatever it is. Okay. But when you say markup, markup is basically when the liquidity provider is giving broker a feed, he is charging the broker a fees on it for that feed. Let's say 1 pip is the charge deployed by the liquidity provider to the broker in exchange of his services. Same way, the broker is going to further transfer this fee as 1.1 pip to his client, making a net difference of 0.1 pip. Okay, so this is the way they can mark up. It's a fair source of income for the ebook broker because he has to stay in market and survive by himself. Now, going to the b-book broker, the well-renowned or the bad boy of the industry, but not actually what it is being told of. Okay, we are going to discuss b-book broker in a totally new and fresh webinar, not in this in detail, but I'm trying to explain all the differences here. In a b-book broker, the broker which has a higher risk appetite, keeps all his trades to his own book, can be termed as b-book broker. It won't have a LP at its back to cover its risk. No, it won't have. Most of the people hate b-book brokers. When they hear it, they think it's a black book or it's a dirty book or it's a loss making book. It's not that way. That's why I said this is a deep topic. I'm going to explain this topic in much detail because I have an experience of more than 15 years in this industry. I have been a prop trader. I have been a mature trader in my young age. I have helped few, not many, but few of my friends to start up their own brokerages. So I was the one who was trying to see how they work because it was even first time for me. So I was negotiating with the banks, with the non-financial institutions, with liquidity providers. And so I know the internalization of trades. So you are hearing from the right person here. Okay. And I'm trying to give you the best of my knowledge for free here because already making money is a tough field as a trader. Because if you don't choose the right broker, it will be very tough for you to choose the right method involved. There are strategies which work with A-book, they don't work with B-book. There are strategies which may work with B-book and may not work with A-book. Okay? Scalping, positional holding, all things are so technically well defined, but nobody's going to tell you which strategy to deploy on which currency pair, with which broker, and what is the risk exposure going to happen. So for the first stage is selecting a proper broker. How do you select a proper broker? If you know how the broker operates, right? So now coming back to the brokerage, what is B-book broker and what motivates the B-book broker to start a book? Even now the B-book broker also knows that there is a A-book, there is no risk on the A-book. Okay, as a broker, you earn from two revenue streams, that is commissions and spreads. Why more greed? Greed is not bad, but it's the terminology. And the terminology is hidden here in the third point. Statistics say that 89% of retail investors lose money in the first quarters of their investment. And what did I say? The B book is who keeps all the risky, or all the trades, let's assume only trades, to his own books. So if 89% of people are losing trade, isn't it 89% profit with the broker? That's enough motivation. Because once the broker starts earning money, he can look further in how to manage risk, how to deploy smart marketsmen, how to bifurcate the trades from this section to that section, but that comes on advancement. So we'll not discuss that topic here. Let's jump to how does a B-book broker make money. Like a A-book broker was making money from 2 transactions, B-book broker is going to make money under 3 transactions. And what are those? One is commission, one is spread markup, and the last is client losses. The first two are coming from A-book process. This is the add-on. Because we know majority of the trades stay on the book of the C book. Oh, sorry, of the B book. Okay. But once again, I would like to repeat, do not take this information as negative information that all B book brokers are bad. There are billion-dollar houses who involve in B book. Okay. There's nothing wrong actually to do B-book. But doing B-book with amateur information is risk for your own clients and for yourself. Because where you see 100% of trades on your book, assuming that 90% or 89% of clients lose money, it can turn out that clients speedily make money and you are holding 89% of your losses, which are profits of the client. You need to think in that direction also. So jumping to the last version of the brokerage industry, which is a C-book. Some renowned people also coin it as marketing jargon, but it's reality. So let's not jump into it and let's face the reality that C-book brokers exist. Who are actually C-book brokers? C-book brokers are the one who have experience, have good financial background with them, have a larger team than single-handed books, have a better access to liquidity, and they can play the role of both A and B book, hence making them the C book. What it means is they do have liquidity providers at their back end to hold their trades, but the process is different, which I have mentioned here, that they can partially hedge your positions with the liquidity provider. They can reverse hedge the positions if they know that yes, you are winning and they don't want to capture the risk. They may deploy algorithms, or they can overhedge your positions if they know you are 100% winning trader, which is very less percentage of traders community. But let's say a broker has access to all your trading history or the journal. Okay, he's constantly watching your trading history because he's your broker. Fine, he is going to deploy a team termed as risk manager, so they are going to constantly study all your trades very well, and then they segregate 10 clients whose losses are just less than 10%, but whose winning ratio is more than 90%. So it's wise activity of the broker to overhedge your positions. Let's say you are sending one standard lot of gold as a buy to market. This C broker is intelligent. He knows you are a winning trader. He will send 1.20 lots to the market because he knows that you are going to definitely win this trade. So he wants to earn additional 0.20 lots worth of profit to his book. And in turn, you will see how the C-book broker is making revenues. So now how does C-book broker make revenues? Already he has access to commissions. He has access to markups. He has a B-book model integrated to it, which he may deploy from time to time, seeing the amateurness of the traders. But here is another terminology added as order flow, which we will also cover, but not in this thing because it's an advanced thing. Okay. But we should coin it here as order flow. Order flow is something that the broker is going to sell all of his trades to his liquidity provider single-handedly. Okay. Single-handedly, he's going to sell all of his trades and ask for a flat fee. That's all. Doesn't know whether you are making profits. He doesn't know whether you are making losses. Nothing. The broker is just going to sell all of the order flow of his book to a larger institution. So you have seen from A book to C book, every time a new grade of brokerage has been added, a new revenue source has been added. So this was a very introductory informational webinar, but I hope it will resolve few of your queries that are going on in your mind. So friends, thank you very much for your valuable time and staying with us and trusting us with your time. We shall be back to you with more information and detailed webinars.